Good afternoon. This is Rich Nass, Executive Vice President with Open Systems Media, leader of the Embedded and IoT franchises, here for my weekly chat with Ray Zinn, who is the longtime former CEO of Micrel, who's a podcaster, and he's lots of other stuff, and he takes a few minutes with us every week. Hello, Ray. How are you?
Well, I'm okay right now. I slipped and fell outside just a little while ago and hit my back pretty hard. So I guess I can't say I'm great, but I'm still alive, and that's the main thing.
Okay. Well, that just shows the audience we do these things in real time. That's for sure. I
Absolutely.
hope you're okay. Okay. So this week's topic, and hopefully it'll be timely for a while, is that the stock market just continues to go up and up and up and up for at least since the beginning of the year. What do you think that means specifically to our embedded and electronics industry, and do you think that can continue?
Well, that's a good question because Monday night, a couple of nights ago actually, I was having dinner with some friends, and they were asking me exactly the same question. They wanted some recommendations on some stocks that I thought in our industry would be good going forward. And so we began looking at the parameters of those various companies, Applied Materials being one of them, for example, and the EPS or the market cap of those companies relative to their current levels have gone up tremendously. You know, I should say I just lost my train of thought, but their price to earnings, the PE ratios, were very high. And so we went over a number of stocks, and we must have gone over 15 or 20, and they all had PEs way above normal. Normal for our industry is in the area of around 15 to 1, or 15 times. And these stocks were, almost every single one of them were well over 20, some were up as high as 50. And what that means is that the belief is that the market is going to continue to improve and get better, but the stocks are pretty high priced right now. So what that tells us is that while the market is going to continue to expect great results, it all depends upon how the economy really turns out. So in my estimation, to justify those kinds of multiples, we're going to have to see GDPs north of 4%. Right now, we're sitting below 2. So we'd have to see the U.S. GDP go up almost double if we're going to justify those numbers. So does that help?
Sure, it helps a lot. But before I move on, would you just take a step back? And you were mentioning something about a 15 times number. What does that mean? I'm not a stock market person, and I'm not familiar with that terminology. What does that mean exactly?
Okay, P stands for price. That's the stock price. E stands for earnings. So if you look at that ratio, then that's the price of the stock divided by its earnings. It's projected next year's earnings, so it's 12 months in going forward. So that we would be looking at January, February of 2018 earnings to justify that multiple. And so they're not looking at what the earnings were last year, but what the earnings are 1 year in advance. And so the market is expecting the earnings for 2017 to be considerably higher than they are today, and so they've upped the stock price. In other words, they've paid more money for that stock in the belief that the earnings will support it, and it'll get down to more like 15 times. So 15 is more the average, and so then you'd say, okay, if for example, if the PE ratio were 30, then they're expecting earnings to double for 2017.
Got it. And if I heard you correctly, you said that this is not sustainable?
Well, okay, to make that happen, to get to double earnings for 2017 in our industry, we're going to have to see GDPs north of 4%. That's a double from where we are now.
And you don't think that that's happening?
I think 3.5 is doable. I'm not sure 4. Again, we're talking crystal ball here, Rich, and so to say, well, do I know for sure that the U.S. GDP is going to double over the next 12 months? I don't know. I mean, that's pretty tough for me to really buy into that.
So you're telling me I shouldn't take my kid's college fund and put it all into the market right now?
Well, that'd be pretty risky.
Yes, indeed. Okay. Are there any pockets within our electronics industry, do you think, that might perform better than others or worse than others?
Well, it's interesting that Applied Materials and Kulicke & Soffa and some of those other semiconductor equipment companies are doing quite well from at least from a market point of view. And that would indicate that the industry itself, from a manufacturing point of view, is going to improve because these are all equipment suppliers.
Right.
So it does say that there is an expectation that the semiconductor industry as a whole is going to do quite well for the next 12 months. And I think that's the answer that you're looking for. As far as pockets of strength, I don't know that most of these companies now are so broad-based that, whether it be, Xilinx or not Altera, but Atmel or not Atmel, they're acquired. Don't think some of these FPGA companies, but that's a good indication that the general market is going to do quite well. So in memory, of course, they're expecting Micron to do better, and that's a general market type indicator. So I'd say any of these companies that are general-based, I think will do quite well.
Okay, well, that's great. I certainly appreciate your time as always, and I hope you're doing okay from that spill you took earlier.
I'm getting better. I just hope my back doesn't hurt anymore. Okay.
Well, I'll speak to you next week, and hopefully you'll be fully recovered by then. Have a great day, Ray.
Well, thanks a lot, Rich.